Cam, Chris, Kieran. My bad, dude. I just had it right too.
It's better than Gary.
I know it's better than Gary. My bad. I'm sorry. Super nice guy, and I've already screwed it up twice already. But thank you for coming, my boy Cam from Foundry. You are the second person from Foundry we've had on here.
Yeah, you guys had Jeff on here.
Had Jeff on here. My boy Jeff.
You're the tallest person from Foundry.
Yes.
we've had on.
Oh,
Jeff, you didn't hear that.
shots fired. But yeah, thank you for coming. So Foundry, CWP, and yes, we will. I'm anxious to have you guys kind of explain what you're doing because the little bit we've talked already sounds pretty cool.
Absolutely.
And a little bit different from what a lot of groups are doing already. So
If you're watching on video, welcome to the shit show because this is number 2 of the day in our marathon while everybody's in town for Empower.
Eating pizza.
We started off with whiskey. Now we're moving on to some tequila and some mezcal. So sorry, this is what you get to work with. So
that's how we roll, man.
Quick overview. Do you want to start? Just give a quick overview for Foundry for people who don't know.
Yeah.
And then we'll do the same thing on CWP side.
Quick elevator on Foundry. You know, Foundry is the world's largest Bitcoin mining pool and, you know, helping decentralize hash rate. We're built to decentralize infrastructure. So Foundry is a prop miner and a mining service company and a pool provider in the space.
So Chris, tell us about CWP and yourself and all that. We want to hear kind of where you guys' backgrounds and all that stuff.
Absolutely. So we work with CWP Energy. I help head up CWP Energy Solutions, which is the client-facing business of CWP Energy. CWP Energy started in 2012. We are a power trading company. We specialize in renewable intermittency, congestion trading, volatility trading, and we really got into the power trading game when renewables started to really impact the system. And what we do over at CWP Energy Solutions is we look to focus that experience and expertise on curtailment, renewable build-out, and then work with our clients to help them better manage kind of contractual risk like basis risk, curtailment risk, volumetric risk. And we kind of put our trading tools in their hands and kind of help grow their expertise in that space and structure partnerships that way.
So is it like, it's almost like demand response, right? But behind the meter more.
So essentially, you know, if you have a renewable project, you know, if you want to build a renewable project, you have to go to a bank or a corporate off-taker and get a 10-year purchase agreement for that power. And then they're going to say, perfect, we're going to purchase your power at the nearest liquid settlement hub. And your project is located over in XYZ area. You're supposed to manage that risk of where your project's located to where the project settles. And then you kind of generate, obviously, your revenues based on what you're paid at your project location, but you owe per that contract revenues based on that settlement location.
Okay.
So there is some dislocations in the market, but you need your project built, so you need your project financed, and that's where we come in.
All right. That's good. Kieran, you want to tell us a little bit about yourself and your background?
Yeah, sure. So I work with Chris. Chris had this idea with their founder in 2021 and basically built the business from an idea. And I joined at kind of the end of 21 in this third quarter and basically came on and headed up our analytics function. So we like to say Chris has the ideas and I kind of make them come to fruition. And
makes it all work.
I wear a lot of different hats. I do a lot of different things. But yeah, my background's mechanical engineering. And then Chris and I actually have work background. We met each other and I actually worked very closely with Chris. Chris was somewhat of a mentor for me at TSCG, the utility in New Jersey. We worked on their real-time operations there, doing anything from dispatching power plants to hedging in real time and doing some real-time financial product trading. But ultimately, you know, we ended up going our different ways, and then he gave me a call about this idea he had, and it seemed exactly what the industry needed. So I'm definitely more analytical, because obviously that's why I head up our analytics function, but that's ultimately how we came back together. And as Chris noted, we work with a variety of different types of clients, both generators and loads, and we're at the end of the day doing a lot of day-to-day, hour-to-hour management, but also looking for the ability to get these things financed and essentially make them profitable. Because as I'm sure you're aware, there are a lot of
can be
stressed
some
assets everywhere,
difficulties.
right? Yeah.
Right. Definitely can be some difficulties in that right now.
What's interesting is we've talked so heavily with a lot of the oil and gas guys. Chris, obviously, just being the one that we just did, obviously talks about a lot of stranded gas, a lot of disadvantaged gas, things like that. So it's fun to kind of take this and now apply it to kind of the renewable side, right? As you were kind of alluding to, it's, you're building out a lot of these large scale build outs and you just don't necessarily have the offtake for that kind of, the transmission lines for those kind of power projects. And so how do you monetize it?
Honestly, it's the $1 million question. Actually, probably more like a $50 million question. But yeah, you're right. There is such an influx of capital that are either focused on the ESG mandates, they want to get projects built, or they committed to their shareholders to be reach certain carbon neutrality goals. So either way, there is just a pool of money that wants to get into the space. But due to COVID, there's been supply chain delays. There's interconnection delays in order to get your project sited and built and permitted. So, theoretically, everyone goes and looks, hey, what are the most attractive areas to build a solar project? What are the windiest areas to build my wind farm? And so everyone kind of builds on top of each other until we reach a situation of oversupply. Mm-hmm. And when oversupply happens, that's when curtailment happens. And that's when people need to kind of manage that. So,
sorry to jump in there. It's funny though, because I guess it's not funny. It's something that people don't realize is the reality for so many of these different projects. Like you talk about how many, new wind programs or projects are going to come on, new solar projects, all that. Getting that power to market is a lot more difficult than what people realize. And actually having an offtake where you can monetize that early on. And sounds like that's what you guys have identified. That's probably how you got together with Foundry, I'm guessing. Can you guys talk about the relationship between you guys and how you're working together?
I would hope so with you, but with you all being here, I hope you can openly talk about this.
No, we can't talk about it at all.
Not step on my own freaking tongue again, but yeah.
We can't talk about the relationship.
All right, no. I want to make sure, gunshot.
So yeah, I was introduced to Chris from another contact at they do like rec and carbon credit trading, and we were looking to get more intelligent on the energy side as a company, and wanted access to power data, wanted access to kind of grid data, start thinking about where we think the next round of sites will be built out, and also getting data for back testing power. At this time, we were like just coming into the energy crisis of last year, 2022. And power prices all over the country were spiking, and we were just trying to get a handle on A, why, B, for how long, and how can we avoid it moving forward. And so we got in touch with Chris at CWP and, started talking almost weekly, bi-weekly, just trying to get more energy intelligent as a company and hedge our exposure to these markets. And we were in an interesting spot because we host a lot of our machines in our prop mining fleet. So we have energy exposure via our hosting partners. So we don't have positive control on that energy. So we can't go out and physically secure power or hedge for that. So we had to look for creative solutions. I'll let Chris take it from there.
Yeah. I'll give Cam credit. Cam's the reason that we're in the space in the first place. But I think where we really got involved is quite a few miners reached out to us in early 2021. They know that most people that have curtailment issues, that have basis issues where they have their project built, but the prices are either negative or very undervalued. And they know that we solve them from a financial perspective. So naturally, controllable loads, physical loads that can actually suck up megawatts are a great fit. And fortunately, we had some good conversations, and then we met Cam, who has an energy background and can kind of link some of the lingo together. And he's like, hey, I need data. I need some advisory on some of the stuff that we're working on. And we get to look under the hood of what they're working on at Foundry, and he got to see the capabilities that we had at CWP. So naturally, our relationship started from sharing data, advisory, and now it's moved up to managing and optimizing some mining sites and working through contracts and things like that.
What is your background in energy? Because you didn't really tell what it is.
Yeah,
I know what it is, but I want everybody to know.
Yeah, so I got
If
my
you can
start.
talk about that.
I can also
All right.
talk about that.
All right.
I got my start in energy right out of school. Interviewed up and down the East Coast. It's like 2012, late 2012, early 2013. And I wanted to be in energy. I was at Pitt in Bradford, which is a branch campus, and am in Bradford, PA, the middle of the like Marcellus shale boom, and everything natural gas, everything oil and gas is going on out there. I had friends dropping out of college to go work on wells, and so energy was everywhere, and I just kind of got addicted to it. I knew I wanted to be in the space. Interviewed up and down East Coast after college. Said I'm never going back to Buffalo, New York. And the first job out of college, or the best offer I had on the table, was at a mom and pop energy consulting company doing commercial, industrial, electric, and gas hedging for other people. And 6 months in at that company, we got bought by NRG. So I lucked into like a nice Fortune 5 energy
I didn't know
job.
that.
Yeah.
Oh.
So we were two companies doing gas and electric hedging, and then we were a large demand response, early mover in demand response in the Northeast for PJM grid, New York ISO, Ontario, and New England ISO. So that's why NRG got interested in the company, and we ended up getting bought by them and got into cross-selling all the different NRG commercial industrial suite of products through that job, and naturally got the taste as energy kept dipping their toes in renewables. Got the taste for renewables and decided, I think it was 2016, I jumped ship and went to a CNI renewable developer in New York doing rooftop, ground mount, carport renewable development. So I was doing business development, signing contracts, but also managing the projects up until construction. And then moved on from there to a more bigger regional player in that same space.
When did you first realize that you wanted to get into like the Bitcoin, like how that's going to interact with like Bitcoin mining?
So 2-part story. I'll keep it quick. In 2012, in my dorm, right before I graduated, one of my kind of techie friends introduced me to Bitcoin, and it really resonated with me, being kind of like a product of like coming through high school and early college of like Occupy Wall Street movement and like all that in the forefront. So Bitcoin really resonated with me back then. And he convinced me to get like a Raspberry Pi miner. And like, I don't think I mined any blocks. Like it was completely pleb, like super novice, but it was like interesting. And I bought some Bitcoin, played around with it, and then like got the job, moved on, and I was like gone, to the wind, right? 2017 rolled around, started seeing stuff about Ethereum, some of these other coins, and then Bitcoin in the news, and like got reinterested in it. And then it was like late 2019, early 2020, I got back in the space. I came fully orange pilled down the rabbit hole and spent the majority of 2020 trying to figure out where can I pivot my career from, 10 years of energy and physical infrastructure development to crypto. I was in all sorts of altcoins and everything.
Yeah.
And naturally landed on mining. Come 2021, Foundry started making noise, and I realized that they were in Rochester. I was in Buffalo. I had a contact that I had previously worked with, ended up getting a job there, and spent 6 months and finally got hired, and the rest is history.
Pretty much the perfect schooling
Oh,
on someone else's
yeah.
dime.
Yeah, that is the best kind of schooling, because I'm still paying for mine. That's brutal. But yeah, but you guys, when you got with Foundry, so what is the objective here now that you're with them? Are you guys going to be basically acting with them to locate sites, or like what's the relationship?
Yeah. You want to go?
Yeah.
Go ahead, Kieran.
Can we talk about it?
Yeah, can we talk about it?
Yeah, we can talk about it.
I feel like we're like disclosing all kinds of like deep secrets.
So
we signed some legal agreements, but I think you can advise us on those.
All right. Martin Legal, we can advise people on all kinds of legal matters.
Nice plug.
Yeah.
we work with Chris and Kieran, and they've really helped us advise on different deals that come across our desk just on energy outlook, whether it's looking at the past 5 years and kind of seeing how 2022 was an outlier in the natural gas markets, but also being aware of kind of what the other risks could be moving forward projections. And as we're kind of seeing these things come across our desk, we're in the middle of the space. We're seeing all sorts of deal flow, both public, private, bankrupt, and just trying to get more energy wise around the deals we're doing, whether it's a hosting contract for our own prop fleet, or if we're advising a company on investing in a new Bitcoin mining site in a deregulated market. Just becoming more energy wise on it. And then naturally, the more we've talked, the more those kind of conversations have gone. And we don't have a mandate to go out and develop our own.
We can't cut that part. That's gonna stay.
That's the best feature of these chairs.
Yeah, we don't have a mandate to go out and develop our own greenfield site. So it's not sourcing land, it's not sourcing power, but we're also opportunistic. We're not going to pass up good opportunities, when they come across our desk. And that's kind of where CWP helps us identify what is actually opportunistic.
Right. Two things really impressed me about you and Foundry in particular. Or I guess Foundry and you in particular. First one is you didn't skip a beat after you just dropped your chair like that and bounced right back in there. That was pretty impressive. Solid. But honestly,
where's he going?
Yeah, I know.
How low does that chair go?
I know. That was like something out of a movie. But Foundry really has. I've noticed this from the first time I started talking to you guys, and that was a while ago. I guess probably 2021, early 2021. It was very early 2021. You guys have shown put forth a lot of effort in developing like the knowledge on the energy side. It hasn't been, I have not seen any of the other groups that are, pools or groups like y'all that have put an emphasis on really understanding the power markets, because I think that's obviously key in this industry, but you guys have really put an emphasis on that. And every time I talk to people at Foundry, they're always asking a lot of questions about deal flow and what kind of deals we're seeing and what route we're going, whether it be renewables, gas, whatever. They've just shown a lot of interest in kind of being educated on that side. So going back to you guys, now that it sounds like you're almost acting as like a consultant for you guys on kind of larger scale deals, or maybe even bringing opportunities to them that you might know about. Is that part of, I guess, your business model? Are you guys wanting to be like a group that other folks can reach out to and say, hey, we're looking for this type of asset, and you guys might be able to like put them on one of those assets? Is that some of what you guys are doing?
Yeah, honestly, great question. We kind of fell into the mining space, so almost on accident, because, the problem around the country is the more renewable build out, the more intermittency on the grid. And relying on that intermittency can sometimes lead to very, very low prices or very, very high prices. So essentially, we're already solving that problem for solar and wind and other assets as well too. But when we met Cameron and Foundry, it kind of synergized with our business model. Instead of solving it with financial solutions, you can also solve it in areas with physical solutions. And in say pre-2021, pre-winter storm Uri, actually in ERCOT, everyone thinks of Texas Power as being relatively cheap. So mining what makes the most sense. We have cheap power. We want a fixed price for our cheap power, and that's how it happened. But now you look at last year, power went through the roof. Right. Natural gas went through the roof. So miners or energy companies that were used to dealing with one thing now have to get very, very sophisticated in a very technical subject. Mm-hmm. So it was a natural fit between us and Foundry to say, hey, we have the technical expertise on the power trading side, and we're looking to partner with companies like Foundry,
large load companies, and
large loads. Large loads are really a way to offset the total cost of the transmission build out. If you're a large controllable load, you're essentially a battery storage asset that can't generate. And if battery storage assets can, get tax credits, can, be socialized amongst ratepayers, things like that, why can't controllable loads do the same thing? And you'll see when we have like a big energy event, you can look at what happened in PJM and Winter Storm Elliott, or you look back at Winter Storm Uri. The first things that come out are, hey, look how well load responded, and load was able to curtail to save the grid. And I think having more controllable loads and flexible resources is the only way to move forward and keep our grid balanced on day-to-day basis.
I agree so much, and it's annoying that I'm sorry,
It's a busy week.
Yeah, but the amount of people that don't understand that, and especially that are in the energy industry, right? Especially the power generation side or like utilities. I had a little documentary I did with Bloomberg Green not very long ago. Well, we filmed it last year, but it just came out not very long ago. And they cut out like my entire discussion on that part. And they had one short little blurb in there. It was like where I was talking about kind of moving the load from, from Bitcoin miners to residential or commercial uses. And they basically were like, oh, that doesn't make any sense. We don't know what it is. But then at the end of it, when they actually brought an ERCOT guy in, he basically confirmed exactly what I was saying, but they had cut it out coming from the mining guy. And I think there's, I think there's an active reason some of these groups do that. I'm not putting Bloomberg Green in that. I enjoyed those folks and was happy to get the chance to visit with them. But that is a real thing. And you guys obviously are in the position to recognize that coming from the space that you're in. Do you feel like the miners are getting more educated to kind of this aspect of it where you got physical trades and then you got kind of
yeah, they don't have a choice.
Well, have you seen a growth in them and
the
how
guys
they
that
understand
are left have to understand
Right,
that,
okay.
right? Like
Yeah.
2022 kind of flushed out the inefficient capital to an extent. If you had a fixed power cost offtake and you were never able to mine because you're passed through a cost of power that is unprofitable,
Right.
you're no longer producing revenues to pay off the debt that you used to finance your site. So you're
done.
up there, you're not operating, right?
Yeah.
So it was kind of like an evolution of the industry that forced it upon people. And now you see very sophisticated players, Foundry included, where they're like, hey, not only is my mine producing revenue by generating and mining Bitcoin, but it can also be treated as a load resource. And there are other revenues that I can attain to lower my effective cost of mining Bitcoin.
What about on the renewable side? Are you guys seeing more of the groups that are actually building out the renewables, identifying mining as this is an opportunity for us to go lock in some revenue while we wait for transmission lines to
Absolutely.
be built out?
The challenge, and that's where we come in though, the challenge is if you think about a renewable resource, think about just offtake in general, right? Every renewable wants an as-gen contracts. I don't want any volumetric risk. I want perfect match. I get paid for what I generate, right? But a miner wants fixed power, or they want 20 megawatts, they want 30 megawatts of power at this price.
90% uptime.
Yeah, 90% uptime,
yeah.
right? The two don't exactly
98.
mix.
Yeah,
Yeah,
98.
Yeah.
whatever the best figure
Yeah.
is, right? The two don't exactly mix though, right? Like a renewable generator doesn't really want to wear that risk because they essentially have to provide megawatts they don't have. And the miner doesn't want to sit there and buy power they don't know the cost of. So CWP plays a bit of a role there ourselves where we can wear some of that volumetric risk. So you've got a wind generator or solar generator that you're willing to sell 30 megawatts off of. Well, if you're not producing 30 megawatts, you have to buy it from the grid. CWP can wear some of that risk and help.
Okay.
Align the incentives.
Yeah.
It's more the catalytic or the catalytic converter, the catalyst to facilitate the transaction because, as initially when you get in and you bring up Bitcoin mining to a renewable asset, they say, no, thank you.
Right.
And, volatility and this, that, the other. But you see if Bitcoin mines can, or I should say Bitcoin mining companies can withstand 2022 where you have the news headlines, you have high gas prices, low Bitcoin. And now if you look at the assets the way that we look, they're sitting as some of the most profitable assets on the grid right now. And
Really?
you start to say, all right, these companies have the energy sophistication now to make it through a tough cycle. And the other part of it is they spent a ton of money and a ton of CapEx to build some of these massive, 400 or 500 megawatt sites. So you're going to live through a lot of different cycles of low power costs, low gas, low Bitcoin, and vice versa. So
2022, they just all happen to align.
the stars aligned.
It was a complete shitstorm.
Yeah.
You know what I mean? But it's good for the industry long term, in my opinion.
Coming
Certainly.
into the fall of 21, no one in mining was like,
Right.
energy costs. That's like, yeah, we all sought out the lowest cost of
Yeah.
power, but none of us were out there thinking we're going to see cyclical high natural gas.
No, I mean, I do. I was at J at the time, right? And I mean, this is me sounding like I was foreseeing all this, but I did. I think Ryan and I both were like, this is not feeling good when you get gas prices doing what they're doing. It was, and when you looked at like the situation with like, Russia hadn't really taken off yet with the Ukraine stuff, but knowing that if there's any type of upset, it could get super ugly, and it did. And right, yeah, Europe was already having problems, and we're exporting so much.
But
natural
this
gas.
is fall of 21
Right.
at Pico
Oh yeah,
top,
we're at huge
mining revenue
we'll
through
make
the
it, we'll
roof.
be fine.
couple $100
Price
a
only goes
megawatt
up.
hour.
Yeah. Yeah, so we were talking about that on the last episode. Like, yeah, everybody thinks, and they'll do it again when prices go nuts again, and we get another bull market. People are going to be dumb. They're going to get out over their skis and spend a lot of capital they don't need to spend.
I do think a lot of smart capital will learn from what happened
I think so
late
too.
21 throughout 2022. There was a
Right.
lot of people waiting to get in for the right time,
Right.
and that time's coming.
It
It's
is.
either now or it's coming soon.
I agree.
And they're going to learn. The investment thesis is going to change. People aren't going to be looking for returns in 18 months. They'll probably separate their infrastructure capex from their ASIC capex, and hopefully that can help mitigate kind of the leverage flush that we saw in 2022.
I hope so too. The access to capital for miners is so bad. The money is so expensive that until that changes, there's always going to be like extreme busts like we've had with a lot of miners that are very visible and everybody knows who they are. And then it's like,
Sure.
they're
Is
going
it just because it's so volatile and because it's so risky that the capital's so expensive?
Yeah, right. Like and because the mining equipment goes up in value so fast, right? And it's the same equipment that you're buying today for $2,000 you were spending over $10,000 back, a year and a half ago. And so I think that when you put a loan out for that, I think we're going to see like the valuation on the hardware is going to be, it's going to be hard to get enough capital from somebody financing it when prices go back up. It's going to be tough.
I think it had a two-pronged, both positive approach though from both sides when you go through something like 2022, because it showed renewable energy companies and developers of these projects that we work with that said, that's not for us, too volatile. But when you look across, the pond and you see an industry go through that, and then you see people come out the other side of that, you have to recognize and
It's
respect
real.
that. And the one thing that's been a knock against the mining industry, I think, from the energy side, is that it's not long term. This is someone that's
fad.
solving a flaring gas, or this is someone that's not going to survive 5K, Bitcoin, or things like that. But we've kind of gone through that. We proved that. And now our clients are more saying, if there's an operation that wants to come in for 3, 5, 10 years from now, we're open to that. And, you kind of alluded to it earlier and we skipped over it, but we have clients ask us, we have a renewable project coming online in 2025, and we know that this transmission line will be built in 2028. And that's going to solve all of our curtailment problems, and everything's going to be perfect. And we can procure very, very expensive financial hedges for that. Or we can work and kind of cite mining offtake, like in the hotel when we ran into the guy from the landfill gas mining side who's using that to finance his project in the short term in order to get the
Bridge the
capital
gap.
and build his project long term. That's one thing. And the other thing we saw is from the mining side, you saw how miners thrived when Texas power was very cheap, or any power in general was very cheap, and Bitcoin was high. And then when those things converged and collapsed, now miners realize, well, we spent a ton of CapEx. So unless we increase our energy sophistication and use the same dynamic hedging trading approach that, energy companies use, whether it's oil and gas or power, then we're not going to be able to live through multiple cycles, because we're just going to have to sit there and curtail until the price is economic to mine. And so that's a dynamic that people are getting more sophisticated at.
That's good. I brought this up on a couple episodes ago, but I was in the Middle East, and we actually met with a nuclear engineer, and he builds mining nuclear facilities. And he said they would mine Bitcoin if it was zero because of the value and safety aspect of like a large flexible load like Bitcoin mine. There's really nothing like that. And it's obviously, to me, it's the same exact scenario for a renewable group, is that there's virtually nothing that in a utility, like a grid level, a utility on there, is that from a stabilization standpoint and keeping the grid stable at 60 hertz, there's nothing like mining. It is virtually the best base load tool that really has hit the energy industry, regardless of what type of energy you're talking about. And that, I mean, I think when people start waking up to that and understanding it is a legit, serious offtake for renewable groups, utilities to use it as a grid stabilization, generation for what we're just talking about, selling gas back to the grid.
Mm-hmm.
All the different areas where it touches is virtually, I don't know of anything like it. You know what I mean? From a standpoint of like the capital in and the amount of load you can take and turning it up and down so fast. So
and the network doesn't care. It just moves
it doesn't care. Right.
At the end of the day, that's what we're all here for on the mining side. And it becomes the best last case load or even sometimes first offtake in certain situations, because when you don't need it, you can shed that load and provide power to the grid, and the network just keeps moving on.
Yeah, I agree. So are you guys, I know you guys might do some mining, and I asked you earlier, but are you guys looking to get into mining and yourself and kind of, grow that side of your guys' business?
Yeah, I think for us, it's something that we've certainly been exploring. And at first it was one of those things, let's go back to maybe mid 2021, like, all right, we're not going to talk about this. It's not part of what we're doing. And then the Synergies just kind of kept going naturally, where we had some clients that we were solving these issues for financially said, hey, we would be open to permanently solving these issues. And then when you work with other mining companies, you start to realize this would be like a good example of how your brain starts to click. We're going to a conference next week, which has all the biggest renewable energy players and banking players. And I suspect most of the large heavy hitter meetings, they're going to be arguing about 50 cents a megawatt hour.
Really?
And we, with our strategies last year, we added about $5 to $7 a megawatt hour on top of that. When you look at the mining side, we're talking more like $40, $50 a megawatt hour. That
50 cents a megawatt hour?
50 cents a megawatt hour.
Beat each other over the head for these 10-year PPAs at a couple cents.
And so you start to look at the numbers, and the numbers are just something that you can't ignore. And you look at the problems that they solve. We see them solve problems for our clients by shoring up the basis issue and getting their megawatts to curtail. So when you have a curtailed project, your prices are negative and you are forced to shut down. But if you have something on the financial side that enables you to run, you can generate more production tax credits. You can generate more renewable energy credits, which are valuable to the tax equity sponsors, which are valuable to the corporates that have those ESG mandates. And then you also are keeping your project going and living to see another day.
I'm excited. We need to talk off after the podcast, because like if you guys go to that conference next week, I've been putting some deals together. We can put some deals together, guys. Especially you guys the connections with the renewable generators.
Well, it depends how much time you have to
I
run
got plenty
through the
of time.
IRA.
Let's do it. Let's do it. We can do that.
I saw before I came on here, there was an article that came out. I think Princeton University estimated that the grid, in order to get it to a quote unquote modernized state, needs $350 billion in investment.
And that's going to be paid by ratepayers.
Yeah. Right.
Yeah.
Always is. That okay, you're probably going to where I'm going to say something about this. The peaker plants, right? That has been after we had Winter Storm Uri come out or come through 2021, right? Yeah. There was a lot of kind of attention on Texas after that happened.
Sure.
And our power grid and it's not reliable and all this. The reality is I think we're as reliable a grid as probably any of them, but we weren't prepared for that level of kind of weather coming through. But you had a lot of people, even guys like Warren Buffett, come out and be like, we need to build peaker plants and all this. And he's anti-Bitcoin guy, but that was going to be like, I think $8 billion is what they were going to were proposing for 10 different peaker plants. That all was going to get passed on to the ratepayers, right, and consumers. Whereas you could use Bitcoin mining, which is private industry, come in, bring their own capital, and provide revenue for these utility and for these renewable projects that is not going to be costing taxpayers and consumers additional revenues. And that's why, to me, this is like, it's such a wonderful tool for everyone because we're going to develop a lot more reliable grid, cheaper energy because we're going to allow these renewable projects to come online and give them time to stay afloat while the transmission lines are built out, which I think that's one of the biggest aspects of the infrastructure bill that was passed was transmission lines, but it takes time, like you guys are talking about. And so that's where I think Bitcoin mining is like, it is the ultimate tool for groups to come in, create jobs, create tax revenues, and bring private industry to solve a problem the public suffers from. So I'm a big fan of it, obviously. But,
Yeah, honestly, where I think like picking up on that, that 350 million that Princeton quoted for the modernization of the grid, billion, yes, of course, the B. The IRA is 370 billion of tax incentives.
Really?
So if you look on that on apples to apples, how much capital inefficiency are those tax incentives, going to have to go through? There's going to be some great projects. There's going to be some not so great projects. And capital efficiency is pretty much the name of the game these days. But if you have a battery storage asset and you're eligible for tax credits, or if you have a battery storage asset and you're eligible to say, hey, I offset this transmission project, therefore I can socialize some of the cost of my project via the ratepayers. Why aren't controllable loads being in consideration for the same type of treatment?
That's a good point.
So what we've been trying to work with, Cam and other miners is to say, hey, let's go into the data and let's go into our power flow modeling and say, hey, by building this controllable load or having this controllable load in the area, we were able to offset, this amount of power flow on this transmission line. And that resulted in X costs to ratepayers. And there's other companies in the energy industry that do it that says, hey, by building 10 solar plants next to each other, building that 11th solar plant doesn't have the same effect. You're just offsetting another solar plant being built. And I think it's important to realize, when you put money into a renewable project, you put money into a capital infrastructure project, what is the impact of that project, both on, from the ESG side, since that's very important for everyone these days, but also to the overall cost of the consumer. If you're not offsetting the cost of the consumer, then are you really doing any good at the end of the day? Not really. You're just kind of filling your own company's agenda and your own back pocket. So,
yeah, there's plenty of people who like to do that though. But yeah, I'm glad to see the more kind of energy focused guys are getting into it, right? You know how it's been early on. It was a lot of kind of Bitcoin fans, which I'm all about. I'm a Bitcoin fan, but just for the maturity of the industry and to get more institutional money into it, I think you have to have kind of a new level of expertise come in, and really to make the industry viable long term, you have to take advantage of these type of opportunities, right? And
I mean, we're not in it for nothing.
Right,
There's
right,
monetary
right.
value to a flexible load, and that's what markets are designed to incentivize, right? So ERCOT's a great example of where they've got some more efficient market signals for the value of that flexible load. We call them ancillary services, but it's essentially the ability for a load to curtail to an extent to regulate grid frequency, right? Keep it at 60 hertz. So there's an economic signal to be there, and there's an asset to capture it. And that's what we're looking to do, is better capture those economic signals. And that's where we draw the comparisons between battery storage and flexible loads, right? Like battery storage, a lot of those valuations, we look at them come across our desk all the time. 80, 70% of those 10-year, 20-year valuations are ancillary services. It's not shifting power from 1 hour to the next. It's how can you regulate the grid? So that same inherent value that's available to battery storage is also available to flexible loads, and we're looking to capitalize on it. And at the end of the day, if there's a signal to be had, we're traders, right? We're there to arbitrage that signal and capitalize on it, right? So that's the idea. Is we saw the opportunity, we saw the assets that were being built, we saw people who were doing it in a sophisticated manner and people who are doing it in a less sophisticated manner, and looking to establish people or partnerships with the people that are thinking about the same things we do. Maybe not the same concepts, but the general premise of how can this asset make the most of its abilities.
Right.
Yeah, and it's about optimizing a kilowatt hour.
Yeah.
But when you add in ancillary services, when you add in demand response programs, paid, actual structured programs, not just economic curtailment, you're adding revenue to a project that previously was only making money by mining Bitcoin. Some people buy and hold, some people buy and sell everything, some people have complicated strategies around that. But you had one revenue generator. Now you're adding different revenue stacks. You're increasing the pie for that project, but you're allowing for each mining site that's doing that to be more resilient and less dependent on just mining economics.
100%. We were literally just talking to Chris Alfano about that. Same type of deal, is just diversification on your revenue streams is huge, especially when you don't have a hedging market, right? You guys effectively are the hedging market for a miner on the power side, obviously. Do you guys do stuff kind of nationwide or?
Yep. North America.
Okay.
I'd say North America. Obviously, Texas is a big focus, but SPP is also a big focus. So SPP.
Where's that at?
It's, I'd say, from Oklahoma. If you go straight up into the Dakotas, would represent SPP.
Gas guys would call that the mid-con.
The mid-con,
that's
yes.
right. Yeah.
Yes.
Good job, man.
So the same issues. Some actually 2 weeks ago, the grid was powered by 75% wind.
Really?
Guess what prices are when it's powered by 70%?
Nothing.
Yes.
Less than nothing.
Yeah,
Negative,
less than
right.
nothing.
You're
have to
paying
pay.
to be online.
Yeah. That's
So
awesome.
citing physical load, that's not going away. You're not building a transmission line overnight, or you're not all of a sudden popping up a ton of fossil generation on the other side. So what are you doing in the meantime? Are you just sitting on the sideline and let your project, face those issues, or are you being proactive about it?
And with the IRA, it complicates it. You have a rush, another land grab, more development in the renewable space. So you have projects aging out of their production credits, where now their competitors are sited 15 miles away, same transmission line, and they can drive the price to -2 cents a kilowatt hour because they're getting paid 3. And the project who doesn't have a production credit now can't make revenue. So they're just being curtailed ultimately. So they need a load to come in, or else they're going to have a distressed asset, or already do.
And also, it's not to say that there can't be homeostasis. We've worked through contracts where the mine and the renewable asset work in tandem, where they say, all right, if pricing is below $10, the mine's fully operational. Between $10 and $50, the mining has an arrangement, kind of a VPPA, a virtual power purchase agreement. And then above, say, $100, the mine can share in revenues of the curtail their load, and then share in revenues of the energy product. So it really creates a homeostasis around, hey, you're a flexible generator, you're a flexible load, or even if you're a renewable resource, you can still maintain that with contract flexibility, and it kind of has both ecosystems coexist at once.
It's the only way to align incentives. If you don't, you have two industries. One is pushing to sell power at the highest price, and one's trying to get power for the cheapest. You just keep butting heads. So unless you have contract structures like that align incentives, or you have a vertically integrated kind of asset, it's the only two ways to do it.
You guys are way smarter than me.
Well, honestly, I was about to jump into that because maybe the Martin Legal Group could help.
Yeah, we can do it. We can do it.
Could help on the contract structures because honestly,
we can help on the contracts. Yeah,
the contract side of things is, we know the value of energy and what's going on, and the miners know the Bitcoin mining side and things like that, but we don't know once those two ecosystems come together, who's going to be on the right or wrong side of the contract. So we really focus a lot of time and have a lot of conversations to try and think through. And the only way to do that is to be fully transparent and say, hey, this is what we think the economics are going to be if things go terrible for us, if things are in the middle, and if things are high. And Cam or other miners have to kind of trust and share that same, relationship, because these contracts are very new. We don't really know. And for us coming and trying to optimize a mining site the same way we optimize an energy site, all we want to do is create a contract that both parties earn their fair share of the contract. And if we have to amend the contract or create some flexibility in the contract, we're going to do that, as opposed to many energy companies that have been very successful and grown to these big energy companies in the industry where this is our contract. Mm-hmm. Figure out how you're going to fit into that contract, or the utility. If you're trying to work out a rate structure with them, these are our rate structures for interruptible loads. Fit into that.
And you're dealing with dinosaur companies at that point.
Yeah. This is a brand new industry, right? And it's very similar to oil and gas, but it's still very new. And you can't just kind of cookie cutter contracts based on industries that are completely different than this. There are, certain, like from a business model standpoint, very similar aspects to it, but it's still a very new industry. And you got, not competing interests, but you got companies that are trying to align, but they got very different interests and models in that regard. But yeah, we definitely help. We definitely help on that.
The only way you got to get in the same room as these guys and have a few beers with them.
Well, I'll do that, or some
really
tequila.
About,
Milagro Reposado Select Barrel.
All right. Well, thank you for the tequila. Jake,
I'm cutting myself off, dude.
Are you?
I'm gonna have to cut myself off. We got a whole other podcast.
I know.
I'm gonna be asleep by like 5 p.m.
Oh my goodness! I know you've been really quiet. So
I know.
I'm like,
a lot of this shit's over my head today.
I mean, energy and mining is definitely something new. I always kind of went through all of your old podcasts on the oil and gas side, and every single time I found myself going into my phone and adding in notes and saying, this is the same thing that we're trying to solve on our side, but you guys have already done it on the flared gas or, intermittent side with a lot of the other energy companies.
Those
so
wildcatters.
What wildcatters. What type of synergies do you guys see, in terms of the stuff that's popped up on the flared mining side, and also this, basically synergizes, you have stranded energy with curtailment on some of these days, and does anything
I think the stuff that we just talked about with Chris was really interesting.
Yeah. The aspect of diversifying your business model and finding ways to, now his is not flare gas. His is, they're buying their own asset, their own natural gas asset, mining off of that, and then they're looking for different ways to create some diverse revenue streams. So power generation on site to sell power to the grid when the price is right. Traditional gas sales, because these are tied in. And he brought up a good point, which we've talked about in the past on the show, was the amount of flare gas that there is. Like when you look at just the number, it looks big, right? But it's mostly intermittent flare. And so you don't have a ton of opportunities on the flare gas side. Everybody's fighting over the same stuff because there's very few wells that are actually flaring a ton of gas on a day-to-day basis. They'll flare a lot when they IP the well and they bring it online, but that stuff drops off and then you got it tied into a pipeline, you're selling it. I brought this up on the last episode too, but we did a look at all the wells in Wyoming that had flared. And I want to say this was 2019, but all the gas wells or all the wells that flared in Wyoming, there was only like 2 wells that flared at more than 200 MCF for over 180 days during the year. 2.
Wow.
And so that kind of shows you that there's not a ton of flare gas sites where a miner could go build a company. You know what I mean?
So are miners being mobile, or are they moving around?
They're in. You gotta bounce around to find these different sites, right? But
that has like a huge scaling issue too.
It's a scale issue. And so if you want to become a big off-grid natural gas miner, you really are going to have to find a way to get fully integrated, like Chris over 360.
Do you see a lot of midstream plays?
I think midstream is where it's at, honestly, because they have so much gas coming in on a daily basis. And a lot of these groups, I actually brought one up to him after the last show. A lot of these groups have what you'll call equity gas, which is basically it's gas they own, that they can do whatever they want with it. And I think educating them to the realities of the revenue that you can generate from mining is key, because most of the time they just don't believe you. Like when I've told people we were doing $45 an M, they're like, bullshit. There's no way. And I'm like, I could show you. And even sometimes I show them, they're like, nah, you're not doing that right. Or, they argue with you about it. I'm like, all right, man, I'm not here to like just try to make you money, you know what I mean? But whatever, if you don't want to do it, then you don't want to do it. But we're still so early in this industry that like people don't understand enough about it. We all are in the echo chamber, right? Yep. And you guys are probably in it too now.
We're getting there.
The Bitcoin Twitter world, where it's like, it seems like we all know this stuff. This seems so common, and like, oh yeah, everybody knows. Man, there's hardly anybody that really understands it. But you looked at it from a per capita standpoint, we're probably well under 1% of the people out there, that even people that understand the energy industries or industry markets, they don't get it. They don't understand it. And they don't, like, when they think of like, when you talk about Bitcoin being energy, like, it doesn't even make, what are you talking about? But that's literally what it is. That is what it is.
That's part of what we're doing together.
Right.
There's so much of industry disconnect, but we're so dependent upon one another, right? Like your principal cost of mining is energy. And if you don't understand that,
80 to over 90% of your OpEx in some cases is your energy.
And we're looking at a huge influx of controllable loads, particularly in Texas, but across the country. And you've got utility guys that have looked at vertical demand for the entirety of their life. That's why they cut you off at Bloomberg.
Yeah.
They're used to that vertical demand curve. It doesn't move. So you make it elastic. It's price responsive. Suddenly every model that's ever built to forecast power pricing needs to be changed, because previously it was, here's my supply curve, where's that intersect with my vertical demand? Now I have a flexible load that's going to turn off at $100 per megawatt hour. What does that mean? How do I accommodate that?
Like, I feel like I understand it pretty good, and when you're talking, I'm like, what does that mean? Yeah.
Well, that's why Kieran runs our analytics department. He's above his own in terms of brain capacity. But for us, when we come down here and what we're looking to do at an Empower this week is, we have problems from the energy side, and we come down here and say, hey, these are the problems that our clients are saying. This is what we're trying to solve. I think it kind of synergizes with some of the stuff that you guys are doing. So how can we work through this together? And the main thing we hear from the energy side is, well, wouldn't the miners just pick up and leave when the power prices go up? And so they want miners to stick around and invest that CapEx and build these big sites that they want.
PPA, man.
But at the same time, I have very, very large, who I would say the large major renewable players saying, Chris, can you get a miner in here for 3 years with 100 megawatts of capacity that can, at least provide me enough of a price floor or a revenue put so I can take that to my finance department, finance my project, and get my project built?
That's where I think we could help you.
So
it's more about coming up with a deal structure that makes sense for everybody. And that's what we do at Martin Legal. So
yes. It's a great space to be involved in, but you don't get these problems solved by being over Zoom or not sharing details. First off, someone who's a CEO at a company a couple of weeks ago told me trust and take risks. And in this industry, you have to trust other people who you're working with and trust across the industry and be transparent with your information. And then you can work around contracts, you can work around earnings and things like that.
That's
I'm going to turn to the camera for this one. Trust, but verify.
Good job. Yeah.
Sure.
Spoken like a true miner.
Right. I was actually thinking that too. but that is an aspect that, going back to the oil and gas industry, that is just something that I noticed when I first got into it, is nobody trusts each other and they're always trying to hide. And like, as a landman, so I would go to the courthouse. This was like during law school. I'd go to the courthouse, and you got people that are like guarding the books, and they don't want to tell you what company they're working for and all this stuff because it's all big secret. And it's like, guys, look, we all know who's doing what everywhere. It doesn't matter. And the mining space is not as bad, but it's better as far as like, I think, being open about stuff.
I find in the mining space, there's a ton of people who are willing to share knowledge and data around the newest techniques. Like, think firmware, think software, think what suppliers are the best to work with. But there is a little bit of the caginess, and I saw it in the renewable development world. Everybody, it's the land grab, right?
It is
like,
a land
because
grab.
that's where the money's made.
Yeah, you're right.
But when you're coming to a table with a group like CWP and their energy partners, you have to be transparent. It has to be open book, but you have to expect that from the parties you're with too, or else you're never going to get a deal done. And what's worse than spending months and not getting a deal done?
I do it all the time. It sucks. It's the worst.
We actually experienced that coming before here. We were like, hey, are we going to be disclosing the most attractive mining locations for 2023?
Not yet. You're going to wait until we turn the camera off, and then we're going to work together and figure that out, and we'll knock it out of the park.
I think you'll like my answer to this. I said people that know what they're doing already know where they are.
That's true.
So
that's true.
That's part of it too, though, right? Like, we talk about the sophisticated players in the space. You can be open book because generally everyone has an idea of what's going on, and if you talk about it and they're unsophisticated, they're likely not interested anyway. Like, you're likely not inking it,
and you won't be interested in them either.
Well, they can't see the value in the deal, right?
Yeah.
If I can't tell you what the value proposition is, or you don't understand it, you're never going to sign it. So it's a bit of you got to see eye to eye on things, and if you don't come honestly to the table, then no one's ever going to sign anything.
That's true. That is true.
Yeah, maybe when the camera turns off, I'll give you my alpha list.
Yeah, all right, good. That's what we need. We could do a lot together, man. Let's get some of this stuff done.
I mean,
knock it out of the park.
Honestly, I think everyone knows, West Texas, it's no secret.
Yeah.
South Texas is there. But once we start getting into, SPP or even get into the Illinois region where you have MISO and you also have PJM, that's where everyone started to.
PJM is where I'm hearing a lot of
in Ohio.
Chatter and talk, yeah.
But I just got off a call today with someone who advises very large renewable companies, and they're building tons of projects in Ohio. So you also have it from the load side, and you have it from the generation side. So it seems
It's a
pretty
pretty liquid,
pretty balanced fight.
Too.
And that's the thing. It's a liquid energy market that there's always a market made. There's always liquidity. So both sides can hedge. It's very transparent. Whereas other sides of the country, like SPP, there's not a liquid financial market. So there's not really hedging capability. And what we've been impressed by, I guess, in the past year, and Cam's kind of a secret weapon because he already knows the energy side of things. But when you have a liquid point to hedge, that is something that everyone in power knows, everyone in Bitcoin knows, everyone in gas knows. Because you can say, all right, well, if my project goes up or if it goes down, this is what I can do. I actually have a liquid marketplace to transact. And the fact that we're getting questioned by our mining clients now, hey, should I sell some of my power offtake in June or July right now? Gas has gone up 50 cents in the past 3 days. And as we speak today, it's gone down back 50 cents. But last week, we got a bunch of questions that said, hey, we own cheap offtake at, let's call it $15. Should I sell that and just, create some cash flow and move on? And the fact that those things come to mind instantaneously now is very impressive. And
growth,
the growth, sophistication, and mining companies are are going to be a big part of the grid in the future, whatever way, they participate. So that's why, we're in the industry.
And the energy majors are taking notice.
They are.
They're watching. They're here. They're participating in some ways.
Shell sponsoring Bitcoin 2023.
Yeah.
They should have been sponsoring Empower. We're in Houston.
You heard it here first. You should
You know what
sponsor.
I mean? I don't know what they're thinking there, but
Missed opportunity. Sean.
missed opportunity. Yeah.
Yeah,
You're lost, Shell.
I know that we said that we're not allowed to do company names on here, but if we were able to say some of the developers that are considering and are involved in mining operations,
We didn't tell you couldn't say company names.
we were sworn.
Oh, this is a
secrecy.
pre-powwow.
But all of the largest renewable players are considering mining. They're working with mines already, so the whole stigma, I think, has really taken a peel back in our industry. And it's like, hey, are you gonna put your hand behind your back just because you don't understand something?
Right. Well,
I think that point is already out the door.
And I think Giga does probably the best job on their pitches, which I've seen some of like Brent's pitches. Man, he's incredible. But they pitch everything as infrastructure play, which it is, right? And that's flare gas stuff. But that's one of those areas where it is identical. This is an infrastructure play that allows power generation to kind of thrive, and that's what it is.
People ask where the next wave of capital comes from. It's big energy. It's infrastructure funds.
ESG mandates, whether you want to, whatever your
Right.
opinion
It
is
doesn't
on
matter what our
ESG
opinion is.
mandates, the money's coming. And we had slide decks that had production tax credits, renewable energy credits as slide 7, slide 8. And we realized that we have to move that to be slide 1 because you need tax equity investors to be in your projects if you want to take advantage of the IRA. And corporate companies are investing billions of dollars in energy and they need renewable energy credits. So when you have something that's saying, hey, my renewable project can produce even in a negative price environment, and by bringing mining into the forefront, this is one of the tools that we enable to produce production tax credits, to produce renewable energy credits. How are you going to hit your 2030, 100% renewable mandate without all the tools in your tool belt?
And those guys are getting smarter too. We talk about like inefficient capital deployment and market headwinds weighing on revenues. Like the off-takers have seen some of that as well. They're not alone in suffering from some of these basis risks we talk about, right? So talk about everyone
They
kind
have
of
to wear them more now.
Yeah. We talk about everyone trying to get a little bit more sophisticated. They're coming to the table because they know, they see the value in it. They understand what they can get from it. And now everyone's more open to the conversation because they know more.
Yeah.
Whereas before it's like, why would I entertain that when I can just buy a project at this fixed price for 20 years and not have to worry about it? Well, they're going back to that offtake and realizing it's losing them 10. It might have been not the best idea. How do I resolve that, right? And some physical offtake can help resolve that. There are more creative structures that you can take and help resolve that. So we've seen it everywhere, right? It's not just in the energy seller. It's not just in the mining, but also in the buyer as well. If the offtake sees value in it.
And for the CWP guys, one of the biggest issues for miners that I've seen over the past 2 years is the access to hedging products, and there's a cost to play the game, but there's a cost if you don't play, right? So if you don't hedge, you could pay the ultimate price, and we've seen it happen a few times.
You want to come pitch with us next week?
Let me talk to the events team.
That's literally part of our challenge though, right? And Chris talked about it a little at the offset, but when things are going well, it's very difficult to tell the story that now's the time to hedge, right? Everyone wants to hedge when you're losing a ton of money, when your asset's underwater.
And that's the worst time to do it.
And that's the absolute, you're buying at the top, right?
So some of the most profitable contracts I ever signed in the power business, it was 2013 Polar Vortex.
The best.
The phone's ringing off the hook. I was cold calling 150 people a day, and then to go from like never having inbound calls to inbound calls, it's crazy.
We had a couple calls last week, and this will go to your point on sophistication of miners, where these clients all have projects either in Western SPP or in West Texas or South Texas. And we said, hey, the curtailment is, been subsided because low gas prices haven't been, or, low gas prices are,
These are
part of
renewable customers?
renewable projects. Therefore, the basis, between their project location and the settlement hub has gone from $15 down to $5. And last year they said, hey, anything around $10 we're buying. And now we say, hey, what about, are you buying $5 now? And they say no. The one customer who said, hey, we're going to hedge the back half of 2023 is a Bitcoin miner. And they have large operations in the area, and they are actively pursuing hedging in the area because they're being proactive instead of being reactive. And that was very refreshing to hear someone think about that, as opposed to the conversation where things are going great. They're going to keep going great.
Mhm.
But I know from your podcast, and we've been in the markets for a little bit now, everything's cyclical.
Oh,
Doesn't matter what market you're in.
Yeah, it's everything is.
Especially
Everything
energy.
is. Yeah, no doubt.
Well, think about it in our world, right? Like when things are going well, you're just not losing money. But when things are going poorly, you're losing money. Like the gas world is probably a little different, right? You can probably make a little wider on your spark spread when things are going well. You can recoup some, right? You can,
What is he saying?
Sparks.
This guy's so smart.
Yeah. We usually keep him. We usually keep
You're
him behind the
gas-
curtain.
I'm not a trader.
This is the first time he's talked to
Yeah.
people in years.
I have no idea what you're talking about. Yeah.
Spark spread is the implied difference between your cost of generating power and what you're getting paid.
Okay. Now I know. This is like the more you know kind of deal. So-
Everybody
$1
needs to
per
get themselves a
MMBTU,
Kieran.
$2 per megawatt hour.
Okay. I
Yeah,
get that.
Kieran,
Get that.
Kieran's what makes it all work behind the scenes.
Yeah.
But in the end, you need people that understand both things, but then you also need the translator as well too. So thankfully we met Cam right away. So he
Cam is a great
translated a lot of the
translator,
Bitcoin
honestly.
mining
Yeah,
stuff
yeah,
and
yeah.
made us understand it, and
Well,
vice
you're
versa.
unique. You come from kind of both sides of it. So there's not very many people in the space that have both sides of that. So
And I'm just scratching the surface with my knowledge.
Mm.
The things I've learned from these guys in the past year, it's mind blowing.
is that how long you guys been working together? About a year?
Yeah.
Conversations is probably about a year at this point.
Yeah, we started kind of right before Bitcoin 2023. So what's that, like April or May of 2021?
22, yeah.
Bitcoin 22.
Yeah, you're right, 22. So yeah, we've definitely come a long way. We've
Yeah.
grown.
We were not insulated from the energy crisis that hit worldwide.
I don't think anybody was. Yeah.
Yeah, we didn't back off when
probably
everything happened last year. We doubled
probably
down.
had signal on it,
Mm.
with some European stuff, and still ate a little bit,
Yeah.
as we all did in the space.
Everybody did. I think it was not avoidable at that point. But hey, I think we need to wrap this one up.
Yeah.
We got,
Alana's here.
yeah, Alana's here. She's been waiting, but
It's the
I'm-
marathon continues.
the marathon
Marathon
continues,
continues. I'm
man.
cutting myself off for the rest of
Yeah,
this before
Power
I fall
to you
asleep.
guys. It's a champion.
Yeah,
This is
you
what
were
3
so quiet
podcasts.
this
I was so quiet. I was like, oh god, I gotta pull myself out of this.
But thank you guys for coming.
Thanks for
This
having
was
us.
really
This has been
good.
great.
A really enlightening. We're gonna shut the camera off. We're gonna have to catch up and get
Absolutely.
some deals going.
We're
So,
looking forward to for what Wednesday, Thursday. This
Wednesday,
week. Yeah.
Thursday.
It's gonna be a
Yeah.
good week, man. I'm
And
excited.
Power round 2.
Round
Power
2. Let's do it.
Conferences and
Power, the-
podcasts. You guys have done tremendously.
Ah, we've been having fun.
It's been a blast.
Yeah,
Thank you guys
good
for making it
time.
down. I'm glad you guys organized this, and I wanted to make it happen. So
We'll do it again too. We should definitely do it again.
Yeah.
We haven't had a repeat guest yet, so
I'm gonna go study more about the broader energy markets
yeah,
for the
I'm
next
gonna go
one.
study.
You need to get
sparks.
yourself a
Sound
Kieran.
quite so
Yeah, we
retarded.
need a Kieran. It's like the quant, right? The quant. Yeah.
I'm not a quant.
Oh yeah. Kieran, we have,
yeah,
we have
people-
quants. Kieran's the translator
I'm the
between the
quant
cons and
translator.
us. Yeah.
All right.
So
Yeah, so you're like Ryan Gosling in the big what is it? What is it?
The Big Short?
The Big Short. The Big Short, yeah.
Look at him.
This is my quant. We'll stop it there. We'll stop it there. But yeah. Well, thank you guys.
Thank you.
It was a good
thank
time.
you.
Great.
If you guys like the show, please take 2 seconds, share it with your friends, all your colleagues, send it to everybody you work with, leave us a rating, review. Much love. We appreciate all the love so far. Catch you guys in the next episode.